Alright guys, so welcome to another section of EMFOREX Academy free Forex classes. Okay, so basically I'm Emmanuel Undu. Alright, I'm actually a Forex trader. I've been trading since 2017, but became more aggressive in the market in 2020. Okay, so if I'm not mistaken, there should be about 3 to 4 years of me having knowledge about the forex market, then aggressively trading about 1 year thereabout. Okay, so I think I actually have been able to get some knowledge I could actually direct you through. Okay, so that will actually give you a head start. Okay, so before then, you must have heard about forex trading, you must have heard about forex market. Forex is not actually a new thing. Everybody basically must have been talking about forex, even if people that even trade the market and those that don't even trade the market at all, they basically talk about forex trading. So we're talking about what forex is. We'll be going into the basics of forex trading. We'll be going into mid advance. Alright, but within these 5 days I'll try my best, I and my team will try our best to make sure that we cover the market to a very wide extent, okay, so that you can have understanding of the market. Okay, and okay, welcome Mr. Bolu, welcome Daberichi. I think Daberichi, a female trader. Yeah, you're a female trader, so welcome. I think we have one female trader in the house this time around. Okay, so before we keep diving deep, okay, let's just throw a little shout out to our partners here. We have XNES. Okay, we have XNES. We also have Moga FX. We have Maximus FX. Okay, they are basically EMFOREX partners. Alright, they help us make sure that this training is actually coming in handy. Okay, and at this very point where we all need it. Okay, so welcome you guys, welcome, and let's actually start. Okay, well, before we start, you could drop your name and the location you're joining us from. Me, currently I'm Emmanuel Okorafo Ndubisi. Okay, I'm joining in from Nigeria. Just drop your name and your location in the chat section so we know where you're chatting from. Okay, Bolu, Nigeria. Okay, Lagos to be precise. Okay, alright, Emmanuel, Nigeria. Alright, so we have so many Nigerians here. Alright, Marvelous from Lagos, Nigeria. Alright, Download from London. Alright, so welcome Mr. Download from London. Alright, Salu, Lagos, Nigeria. Okay, so let's just do a little discussion about forex. Okay, I just want this class to be basically more of a discussion section. Okay, so forex is basically foreign exchange. Alright, I don't really want to talk much about the introduction. I really want to talk more about the advanced part of forex trading. Okay, but before we dive into the advanced, we need to know what the basics. Okay, you can't basically have idea of something without knowing where it's actually from. Okay, without knowing the origin, you can't actually understand a particular thing in depth. Okay, so forex basically, which is the foreign exchange market, foreign exchange or FX trading, is a decentralized global market where the entire world currency trades. Okay, the forex market is the largest, most liquid market in the world, with an average daily volume exceeding 5 trillion. Okay, all the world's combined stock market don't even come close to this. But what does that mean to you? Take a closer look at forex trading and you may find some exciting trading opportunities unavailable with other investments.
Like
please,
not talking again.
Just mute yourself please. Okay, welcome. If you're just coming in, just drop where you're actually joining us from. Welcome. Hello Pat.
Hello.
Hello Pat. You could actually mute yourself. Yeah, mute yourself. Just tell us where you're joining us from, and you can go ahead and mute yourself, please, so we don't disturb the flow. Okay, just so we don't disturb the flow. All right. So, basically, okay, Quebec, Canada. Okay. So, basically, the opportunities that are actually available in the forex market are very vast. Okay, and I will be looking into some opportunities. Just like stock, you can trade currency based on what you think its value is or where it's headed. Okay, but the big difference with forex is that you can trade up or down just as easily. Okay, if you think your currency will increase in value, you can buy it. If you think it will decrease, you can sell it. Okay, what a market with a market this large, finding a buyer when you are selling and selling when you are buying is much easier than in other market. Okay, so what this simply means is that on the forex market you are not really looking for people to buy or sell to. Okay, they are actually available. All right, they are 100% available in the market. Okay, so if you are ready to buy at any position, they are available to you. Okay, people that will take up your position are actually available. So you don't go ahead and look for who is interested in dollar, who is interested in pounds, who is interested in yen and stuff like that. They are 100% available, 24/7, 24/5 available in the market. Okay, so that's what this is basically talking about. Okay, maybe you hear on the news that China is devaluating its currency to draw more foreign businesses into its country. If you think that trend will continue, you could make a forex trade by selling the Chinese currency against another currency. Okay, say the US dollar. The more the Chinese currency devalues against the dollar, the higher your profit. Okay, if the Chinese currency increases in value while you are selling, while your sell position is open, then your losses increase and you want to get out of the trade. Okay, so basically what this actually means is that if you are selling while the currency is buying, now let's say for instance now what is actually going on in the world here. Let's say for instance Afghanistan. Okay, Afghanistan, the currency is actually having issue. Okay, the country is actually having issue, and guess what? The currency will no longer have value. Okay, since the Taliban have actually taken over, the Afghanistan currency will no longer have value. Okay, so now people are actually doing what? Running out of the country, doing what? Selling the Pakistan's rupee, okay, against other countries' currency. Okay, so now they are selling what they have at hand at any price available. Okay, so now in as much as they are selling what they have at hand, okay, which is the Pakistan rupee, they are selling it for let's say the dollar, for instance. They are selling the Pakistan rupee for the dollar. Now the Pakistan rupee will devaluate. Okay, people are no longer interested. All right, that doesn't mean that nobody is actually willing to buy it. Okay, if it's on the forex market, people are actually interested in buying the Pakistan dollar despite the decrease in value. Okay, so now people are running away from Pakistan, okay, because of the takeover. All right, they are selling their Pakistan rupee for the dollar. All right, that is just simple forex exchange. Okay, foreign exchange or forex. Okay, so now you bring in the Pakistan rupee against the dollar is what the foreign exchange market is all about. So now in this case, let's say you have the Pakistan rupee. Okay, now what you need to do now is you are meant to be selling the Pakistan rupee, okay, against what? The dollar. All right, so therefore you need to be buying dollar, selling Pakistan rupee. Okay. So now in this kind of case, if you are buying the Pakistan rupee, you're actually going to be in loss. All right, that's just what the forex market is all about. All right, so if the value of the currency increases, you get to earn on the market. Okay, if the value of the currency decreases, you get to lose money. Okay, it's just as simple as that. But interpreting this basic principle to the foreign exchange market is where the big issue is. Okay, so now let's forge ahead. Alright, so we have forex terminology. Alright, there are various things you need to get acquainted to, various terms you need to have in mind, alright, while trading the market. Okay, these are things that are actually there. Okay, you just need to do what? Have it in mind while trading. Okay, welcome every one of you. Welcome. I can see more people joining the class. Alright, we've not really gone too far. We just did a little introduction, and we are basically talking about the forex terminologies. Okay, so now we'll be looking at PEEP, which is percentage in price. We have spread, we have bid, we have ask, we have volume, we have lot size, we have spillage, we have going long, going short, which is your position direction and stuff. We have bullish and bearish markets. Okay, we also have support and resistance. We have currency pairs. Okay, let's go on. We have a PEEP. Okay, a PEEP simply means percentage in price, alright, or price interest points. Okay, it actually represents a tiny measure of the change in the currency pair in the foreign exchange market. Okay, now this PEEP is actually relevant only in the foreign exchange market. Okay, if you go through the internet, you can see PEEP in other different things, but when we talk about PEEP in the foreign exchange market, this is what we simply mean: the change. Okay, a change in price. Okay, price moved from one point to another. It has actually moved by a certain percentage in price. Okay, and now those percentage in price simply means PEEP. Okay, it can be measured in terms of quotes or in terms of underlying currency. Alright, a PEEP is a standardized unit in its smallest amount by which a currency quote can change. Okay, it is usually 0.0001 for the US dollar related currency pairs, which is more commonly referred to as 1/10, okay, or 1% of one basic point. Okay, I'll be explaining this. Alright, the standardized size helps to protect investors from huge losses. Okay, let's explain what we just spoke about here. Now this PEEP, now I don't know, most of you must have seen. Let's go to our charts briefly. Let me see if I have it underlined here. Alright, let's use this guy here. Alright, so I know most of us must have seen the currency quote, okay, or the forex quote system, alright, whereby we have various currency running up and down. Right, so basically this is how your currency look like. Okay, now on the Euro USD we have, this is the base currency here, this is the quote currency. Okay, so what it simply means is that 1 euro, okay, which I'll be explaining the base power. Right, every currency which is the base currency has a power of 1. Okay, so what it simply means here is 1 euro is equals to 1 euro here. Alright, there's an invisible one behind this euro here. Okay, so 1 euro here is equals to $1.1321. Okay, but to round it up to a whole number, we'll just say 1 euro is equals to 1.13 cents. Okay, so it's just as simple as that. Alright, so here we say $1, okay, it's equals to 113.21 yen. Okay, so this is a Japanese currency. Okay, this is Japanese quote here, this is JPY. Alright, the quote system for a Japanese pair are actually different. Okay, so let's not get that confused. I'll be explaining why these two are actually, why the decimal point is here and also why the decimal point is here also. Let's actually forge it, but this is the way the quote system is. Okay, so now we have 4 digits behind the decimal point here. This is the decimal point here, the 4 digits here, which is 1 2 3 4. are the pips. Okay, now the fifth one here is the pipets. Okay, we call it pipets. All right, it is what just like in your clock. Okay, we have the seconds, we have the minutes, and we have hour. Okay, now this is more like the seconds. Okay, the seconds don't really count per se. All right, it doesn't really count. If you are actually told what's the time, please, you won't say 10 minutes after 3 then 2 seconds. Okay, I don't know if you understand me. All right, what you actually say when they ask you for the time, you say maybe 5 after 3, or maybe 30 minutes after 3, or quarter past 2, or whatever the time is. Okay, the seconds behind the minutes, you won't actually say it. Okay, that is the way the pipette is. Okay, but this pipette actually gives more insight. Okay, it's actually what it does. The duty of the seconds to time is what the pipette does to the pip. Okay, if this becomes 9, okay, this will change from 1 to 2. Okay, just as simple as that. So it's just like the seconds of the currency codes. Okay, just like the seconds of the currency code. So once this guy here becomes 9, okay, this guy here will become 2. Okay, once this guy here becomes 9, okay, once this 1 pip here become 9 pip, the next value will come here to the 10th value here will become 3. Okay, it's just as simple as that. All right, so we where we actually are interested in is this digit. Okay, this 4 digits here. Okay, this is what we're actually interested in. We are not interested in this guy here. Okay, so we are not interested in these pipettes. What we're interested in are the pips. Okay, what brokers are actually fighting for sometimes are the pipettes. Okay, some of them fight also for the pips. Okay, but a good broker will actually struggle to fight for pipettes. Okay, and give you very low spread. Okay, where that's why we have Xness to give us those quality advantage. All right, so forging on, let's actually go on to where we were. All right, so let's actually dive in. Okay, now for example, if a pip was 10 basic points, a 1 pip change will actually cause greater volatility in the currency value. Okay, so now explaining what that simply means is, now we actually have, this is 1 pip. Okay, now they're actually saying here is, for instance, now here this 1 pip here is not 1 pip but 10 pips. Okay, it's actually going to cause a very, very volatile market. Okay, just like the gold. All right, the gold actually runs very fast. Okay, the pip value moves very, very fast. Okay, so it's unlike normal currency. Okay, we have also Nasdaq, we have US 30, we have oil. Those are very volatile market because the standardized pip value is not 1, but some of them are 10, some of them are 100, depends. Okay, so what we're actually interested in are this kind of movement here where the pip value is equals to 1. Okay, so 1/10 basically. All right, so now let's actually dive more to understanding pips. Okay, assume that you have a US Euro direct quote of 0.747. Okay, now let's not misunderstand this. Look at this guy here. Okay, look at this guy here. This is US Euro. Okay, I want to show you guys something. Now look at this guy here. This is what? Euro USD. Okay, this is Euro USD, and what we have on the other screen there was what? USD Euro. Okay, so now what actually happened there was a change in what quote base currency. Sorry, there was a change in either the base currency or the quote currency. Okay, here you can see that USD came before Euro, and here you can see Euro came before USD. Alright, so how you get to know it is you just subtract this value here from, like, let's say you minus this or you subtract this from 2. Okay, let's subtract this from 2. It's actually going to give us this other value here. Okay, if we subtract this from 2, it will give us this value here. Okay, this value here. All right, but we're actually using the relevance in price. Okay, this would actually be relevant based on the time it was actually collected. Okay, this also will be relevant based on the time or where the price was at that particular point in time. Okay, currently now euro price is not at this level. All right, currently now the US/euro price is not what this. Okay, I think I have a message. Alright, thank you, Mr. Patrick. Okay, so what this quote means is that for $1 you can buy about 0.774 euros. Okay, so like I said earlier, every base currency have what? A hidden value of 1 here. Okay, as you can see here, US dollar, right? $1. Okay, it didn't actually show here that there's a 1. Okay, but what you need to have in mind is whenever you're reading a quote, you need to bear in mind that there's always an invisible 1 at this behind every base currency. Okay, there's always an invisible 1 behind every base currency, so let's not get this twisted. Okay, so now let's forge ahead. The value of the US dollar will rise relative to the euro. Okay, so now as $1 will allow you to buy slightly more euro. Okay, now let's say for instance now you go to for those of us that have actually traveled out or traveled within states or country. Okay, if you go to the airports, we have over the counter foreign exchange market. Okay, where you change your currencies at the counter in the airport while traveling out. Okay, so you go there, you give them your one. Let's say you have $1,000. Okay, you have $1,000. You're actually traveling to, let's say you're traveling to Nigeria. Okay, you have $1,000 here, and what you're doing, what you're traveling to Nigeria now. The current value of this $1,000 to Nigerian naira would be about, let's say, 500,000 naira. Okay, approximately. Okay, let's say 500,000 naira. Okay, so this is USD NGN. Okay, so now this is the value here. Okay, for this $1,000 you have 500,000 naira. Okay, what this simply means is that 1 USD SD is equals to 500 NGN. Okay, so now let's say you're actually in Nigeria now, and you are actually trying to go back to your country. Okay, you've actually had a nice time in Nigeria, especially in Lagos, and you're ready to go back. Okay, you went back to the airport and you gave them how much? You gave them, let me say you gave them let me say you are giving them back this 500,000 naira. Okay, you are giving them back the 500,000 naira, and by the time you go back there and they tell you the naira value now is about 600 naira. Okay, guys, I think we'll be joining back after this section. Okay, we'll be joining back again. I think my network and Zoom is actually commenting us for 40 minutes for this particular section. Okay, so now you're going back for to your country. What just happened? Okay, so now you're going back and you go over the counter and they tell you what the naira now is about 600 per dollar. Okay, so now what you just have to do is you make your calculation. You have to divide by 600. Okay, you just divide what you have at hand. Now you just have to do 500,000 divided by 600, okay, which is actually going to give you about $833. 833. Okay, and now this is not what you actually gave them initially, okay, but what the value of the currency has actually dropped. Okay, the value of naira has actually dropped, so you have lesser US dollar. Okay, so if the value of dollar actually increased, okay, you will have more naira. Okay, but if the value of naira decreased, you have lesser dollar. Okay, so that's what it simply means. Okay, so let's go ahead. Let's make this quick. Remember, once you get disconnected, do how to join back, okay, for another 40 minutes, then we'll call it a wrap for today. Okay, so now let's have this keynote, okay, this key takeaway, then we try as much as possible to we'll take questions, then see what we can do. Okay, so now most currency pairs are quoted to the fourth decimal place. Okay, a pip represents the last, okay, and thus smallest of these four members. Okay, like I explained here, this is a pip. Okay, this guy here is a pip, this guy here is a pip, in as much as all of them are actually pips. Okay, but this is what we're actually talking about when we say a pip. Okay, the fourth digit of a US dollar related pair. Okay, so this is what we talk about in a pip, the fourth digit. Okay, here also this is the fourth digit here, this is a pip. Okay, so even though a pip is a very small unit of measurement, forex traders are usually heavily leveraged, and even a 1 pip difference can equate to significant profit or loss. Okay, what it simply means is just a slight move, okay, just a slight change in price. Okay, let's say price move actually from 1 pip difference. Okay, most forex traders with huge accounts could actually leverage that 1 pip movement and make insane amounts from it. Okay, so let's not get this twisted. Okay, so some people actually target 10 pips daily, okay, while some actually target 50 pips, depend on your trading, who you are as a trader. Okay, some are scalpers, some are swing traders, some are day traders, some position size traders, which we'll be basically talking about in subsequent classes. Okay, but for today, let's try our best to actually cover this. Okay, so pips are the most basic unit of measurement or measure in the forex trading market. Okay, so here how we can actually know what we are doing, or how we can actually know how to make profit on the market, is to calculate our pips, okay, and calculate the amount we use in taking our positions. Okay, so now let's keep on moving. Okay, I've actually explained this, and now let's move ahead. Okay, so we have the spread. All right, spread is if you have any question, please do well to ask. All right, do well to ask on the chat section. Yeah, I will attend to you. All right, so the spread is the difference between the bid and ask. Okay, so now let's go to normal life scenario. Okay, let's say you're actually a real estate mogul. All right, and you have let me say you have a house you want to sell. All right, or maybe let's say you don't have the house, you have someone that is willing to sell a house. Okay, so you meet the person, and the person tells you, I want to sell this house. What I'm actually asking for is I'm actually asking for $10,000. Okay, what I actually have in mind selling this is a few minutes, please, Dabrichi. Okay, what I actually have in mind selling this particular position is $10,000. Okay, so now you as a seller, all right, you take the price. You know what the person is actually interested in. Okay, you know what the person is actually interested in. All right, I'll recap with the pips in the next section, and I'll just break it down a little further. All right, so you're a seller. You want to sell this house for for the owner. Okay, so now you are actually placing the house for, let me say you're actually placing it for 11,000. Okay, now someone is actually interested in the house. Okay, so now the person is actually coming in saying, I actually want to buy this house from you at the rate of 10,500. Okay, so now the difference between the ask price and
Yeah,
the person willing to buy.
yeah, I own no license. So,
Okay, so the difference between the seller's price and the buyer's price is simply what? The spread. Okay, so now I'm selling something to you for 10,000, 10,000, or let's say 11,000, and you are telling me you want to buy it for 10,500. The difference between those prices, okay, now what will actually make us come to an understanding, okay, what will make us come to an understanding, okay, and say, okay, now let us sell this property to you. Okay, you are saying 10,500. I'm actually saying 11,000. Okay, so now 500 is what is actually causing us not sealing that deal. Okay, so now $500 is actually what? The spread. Okay, so now it is the difference between what? The bid and the ask. Okay, so now let's read further, then we look into more. Right, so this difference is the spread you will pay when making your trade. Okay, so this is crucial for you to understand, because each market and forex pair will have huge varying spread. Okay, the spread can seriously cut into your trading profit or loss depending on a number of factors. Okay, this includes the market you are trading and the type of strategy you are using. Okay, another huge factor is the broker you are using. If you are not using a broker with small spread, then you can often be paying far too much just to make your trade. Okay, so like I said here, Xness has us covered in this aspect. Okay, they are actually a broker with a very tight spread, especially when you're using a very reasonable account with them. Okay, so with a very huge sum of amounts you can get basically raw spread. Okay, uh, let's forge ahead. Okay, so now your broker, where I'll be coming in, where I'll be explaining this spread more, is when I'm talking about brokers. Okay, so you now standing as a mediator between the buyer and the seller. Okay, you are the broker. Okay, so now this spread is actually your broker's fee. Okay, the fee your broker charge you to actually grant you access to the market. Okay, so now this spread goes to your broker. Okay, most brokers have very wide spread. Most brokers have very tight spread. Okay, so it depends on your broker. This fee is basically your broker's fee. Okay, so the market is actually selling at this price. You are willing to buy at this price, but your broker has its own fee in between the price the market is selling and you willing to buy. Okay, so I'll be ending this section now. Okay, let's join back using the same link. Okay, and I'll see you back in the next section.